So good afternoon, everybody, and welcome to another episode of the Unlocking Cannabis podcast with Key Investment Partners. I'll be your host today, Jordan Euclid, one of the founding partners of Key Investment Partners. Today, we've got a very special discussion where we're going to be having a roundtable discussion with folks from different parts of specialty finance within the cannabis industry. So I'm very excited to be joined today by David Kivitz of Excess Financial, an equipment finance lender to the industry, Kyle Schenfeld of Rainbow Realty Group on the commercial real estate side, and Ting Hu of Nabis Capital on the working capital finance side. So with that, would love to pass it over to David if you want to give a little bit of your background and career history and how you got involved in the cannabis industry, and then we can go around the room and everyone else can give their introductions as well.
Sure. Jordan, thanks for having us on and to the whole Key team. Excited to be here today with strong industry peers. My background is in structured finance back on the East Coast. Did that on the institutional side for the better part of 5 or 6 years before moving into private equity at a family office in New York. And when the housing market crashed, moved out to California and started acquiring distressed master planned housing communities that we put back into production and development and ultimately built out about 300 home sites. In 2017, looking for kind of the next capital dislocation and large opportunity, we kept coming across what looked like pretty interesting cannabis deals. And obviously knowing how big we thought the illicit market was, seeing the momentum towards the legal market, we felt that this was an industry that we could do very well in, and there was going to be a lot of opportunity. And so formed a capital structure, started investing in the space, and our biggest portfolio investment ended up becoming Excess Financial, which provides CapEx and equipment finance to the industry at scale and really to some of the largest MSOs and largest customers in the space. So excited about the opportunity, where we think we can take it, and what's ahead.
Great. Now, Kyle, do you want to give your background as well?
Yeah, happy to. And Jordan, thanks again to your whole team. Excited to be here. And amongst strong peers, David and I have worked together or have tried to work together in the past for sure. And it's nice to meet you and Ting as well. So this is great. I was a real estate attorney in my former life. I worked at a law firm in Manhattan called Herrick Feinstein for about 3.5 years. And then my grandfather, who had a real estate company called Gould Investors, asked me to retire from the legal profession to come make an honest living. So I came and worked for my family, who has a real estate company. About 5 years ago, we had been invested in cannabis about 10 years ago. So, we were one of the original 10 license holders in New Jersey with a facility called Breakwater in Cranberry, New Jersey. And, we structured that transaction as a leasehold interest. We weren't actually an equity partner. But I got, when I came over to work for the family, I got curious about it, started going to cannabis conferences. We started doing kind of small investments that were non-real estate, right? We have like a 60-year real estate history. So that's really what we've always done with, light cannabis experience. But we started seeing a lot of interesting opportunities in sort of late 2017, early 2018, did a bunch of equity investing on the family's balance sheet. And then, these were, 3 times your money, 5 times your money, riskier deals than we were accustomed to from the real estate world. But we started seeing opportunities in cannabis that were, sale leasebacks on pretty normal retail and industrial real estate, but at, 15 type yields at the time. And so we bought a few of those deals on our own balance sheet. We were much more enthusiastic about that because, again, from our perspective, it was more secure. We had a downside in a non-cannabis world that we could understand. We bought a bunch of those deals on our balance sheet. We went and raised a fund from friends and family. As of last Friday, we actually just finished out the equity in that fund. So we're raising another one now. I love the industry. It's a lot of fun. It's definitely a small industry. There's a lot of camaraderie. There's a lot of, you partner with your competitors more than ever in this industry. Yep. So it's fun and I really enjoy it. I'm happy to be here. So thank you.
That's great. Thanks, Kyle. And Ting, now to you.
Sure. Jordan, thanks for having me here. And David and Kyle, great to meet. I think for myself, I came really more from a traditional corporate background as well. Worked in investment banking at Centerview Partners in New York, and then transitioned into tech-focused private equity investments at the Carlyle Group in DC. During that time, really started digging my toes in, talking to classmates who, went from my undergrad to McKinsey, dropped out, started their own cannabis ventures, and really saw this, I think, growing opportunity that I was a little hesitant to jump fully into, but made a seed investment, and then consequently over the past few years really saw the industry take off. Coming out of business school after getting my MBA at Wharton, really saw a unique opportunity graduating in the midst of COVID to jump into an industry that has evolved so drastically over the past few years. I think just as I was evaluating the industry, saw what my friends at Cannabis were doing, and really want to be a part of that growth story. Cannabis historically has just been a very much a tech-focused, young, upstart tech-based distributor of cannabis products from a B2B standpoint. And so for us, financing was really not the core product of the company. Financing is really, from our standpoint, a way to assist customers and help them continue to accelerate their growth on the Cannabis distribution platform. I think one of the unique components of our business model at Cannabis is that we are operating on a consignment basis, and so don't take the title of product. And so I think from a customer standpoint, what that means is that there is that gap where they're waiting for retailers to pay them, and obviously we handle that part of the service, but there's still the uncertainty around the timing of those cash flows, as well as the risk associated. And so we thought it would be a great opportunity to step in and really provide that additional support that a lot of customers were voicing as key areas of investment that they needed to really further accelerate their growth.
Fantastic. Thanks, Ting. And to give my background as well, I also come from a traditional finance background. So started my career with GE Capital, spent most of that time on the leverage finance side, providing debt to private equity sponsors, conducting leverage buyouts, then made the move to the private equity firm Partners Group, where I was working on the equity side of leverage buyouts, but working in much more traditional, mature, stable industries. That firm back in 2016 decided to open up a new North American headquarters in Denver, which is what brought myself and my two eventual partners at Key to the city. Naturally, living in Colorado, we saw the massive growth of the cannabis industry for several years. And then for a number of reasons, which I'm sure we'll dig into further in this discussion, saw that capital financing in cannabis was very highly capital constrained. And so it was with that thesis in mind that we decided to break off from that firm and form Key Investment Partners, which is a venture capital focused fund financing the cannabis space. And so really excited to not just be hosting this panel, but be able to also participate, as venture capital is obviously another part of specialty finance within the industry. And so I would now love to kind of take a little bit of a step back and talk from like more of a macro perspective of, I think for some of our listeners that may not be super familiar with exactly how each of our asset classes work, just to kind of take a high level step back and explain some things. So for venture capital, for example, right, the way it traditionally works with closed-end fund structures, which is Key's model, is you'll get committed capital, which is say you'll have your limited partners will commit X dollars to your fund. You'll have a fundraising process, and then ultimately have a final close of that fund, and then have an investment period, call it 2 to 3 years, to invest that capital on their behalf in companies across the cannabis ecosystem, right? And so the benefits for our limited partners naturally are, number one, they don't necessarily, a lot of them see the opportunity in cannabis, but just don't have the industry specific domain expertise to know where within cannabis they want to invest that money. And so what we've seen with a lot of early angel investors who picked one specific company in cannabis, they got burned just because they didn't have the time or resources to really dedicate to fully understanding that market. Additionally, if an investor, say, wants to put $1 million to work in the cannabis industry, well, if they're just investing in a deal directly, then you're having 100% concentration and exposure to that specific asset. Whereas with a fund, you're able to invest that same dollar amount, but get a diversified exposure to a whole number of portfolio companies, with the thesis being that you should theoretically have companies that very much outperform, and while there will likely be some companies that either underperform or potentially even go bankrupt, that your winners more than offset those losers. So you naturally get those diversification benefits. So with that, why don't we go back in reverse order, and Ting, if you want to give a little bit of detail on exactly what working capital financing means and that kind of thing.
Sure. So for us, when we crafted the initial product that we wanted to offer our customers, it was really focused on making it as simple as possible for them to understand and as easy as possible from a process standpoint. And so our product is really non-recourse factoring, so true sales of accounts receivables from those brands where they've made a sale to a retailer and want to just accelerate the funds back to themselves so that they can recycle that into additional cultivation, additional equipment, maybe through David. But as we think about what that meant for us, it was really creating a simple factoring rate as well as an advance rate, and so charging anywhere between 2.5–3% from net 30 invoices on a flat basis, as well as providing the advance of 75% to provide the peace of mind that customers need. So for us, when we finance this, for us, it's really been just a small piece of our business, and so only a really a promissory note that we've been using to drive the debt side of things, and obviously keeping in mind the spread between our cost of capital as well as what is being charged to customers. So I think right now we're thinking about how that continues to scale. Obviously, the credit model that we have doesn't really work once you scale beyond $500,000, $1 million in monthly volumes. But as we've talked to other creditors, we think that there's a real demand for others to get into the space and really leverage our platform and ability to aggregate volumes to continue providing a what ultimately has seemed to be a very safe credit investment for others. So to date, after factoring, I want to say over 4 million of GMV or gross merchandise value on a wholesale basis, we've only really had one write-off on an invoice. And so I think that speaks to, one, the growing professionalism of the industry as a whole, and then also just the efficiency of our internal collections team that goes out and drives the recycling of the capital.
Great. Kyle, over to you.
Yeah. So, I mean, I just consider ourselves really, a financing means for cannabis operators, right? Like the whole premise of, I think, all of our industries is kind of the fact that, cannabis companies are pretty restrained from traditional means of financing. So, I have two products in my fund. We do sale leasebacks, which is just I'll purchase an existing, dispensary or an industrial grow facility from a cannabis company and lease it back to them. That's kind of our max proceeds option. And then we also have a mortgage or a lending platform. And so we'll do, I'll take a first mortgage on real estate. The operator has to actually own that real estate. But, a lot of the times a company sort of is in a building for a number of years and they've put a lot of money into it and they have an option. And so, but they want to own the building themselves. And so, maybe I'll give them 70% of the money they need to actually buy that building, right? Like, sometimes they'll use my capital and go buy the next building, right? And generally speaking, I'm not overly concerned with what the capital is used for, frankly. It's really just, am I collateralized on the real estate itself? And so, I mean, look, we get intimately involved with the cannabis companies, right? Like, it's such a small industry. We connect borrowers, who are retailers with other borrowers who are, wholesalers. And, I think we can be helpful to the cannabis companies in a number of ways, but the bottom line is that we're really just a source of capital where, others are traditionally unavailable. And we're using the real estate as security.
Great. Thanks. And David, how about you?
Yeah, a lot of what the group has said, are sentiments that I'll echo, which are, we are focused on a certain tier of customer. So, I think similar to some of the other products, there's a massive need. The demand is not being addressed through, traditional channels that are, available in other industries. And so what's kind of interesting about what we all do is what we're doing isn't necessarily new, right? It's not unique, but it's new and unique for our industry. And so, build a capital structure that is in place to service this industry is by and large what all of us are doing to approach it, of course, with different products. Now at Excess, our focus is, what we deem to be the second largest kind of heavy infrastructure need of the industry. So next to real estate, which is a natural place where a lot of investors have started, because it's an asset class that people tend to want to understand and can understand better, just given that it's a primary food group we have focused on CapEx and equipment. And so, you know, what is happening across, you know, our customer base, which is largely multi-state operators, companies that are doing, you know, a minimum of probably 30 million a year in trailing 12-month revenue. We're looking for profitable companies and/or companies that are soon to be profitable and have direct line of sight. We're looking for companies that have kind of removed the execution risk aspect of their business. And I'm sure we can all have a nice chuckle about what we've seen over the last couple of years in terms of what we mean by that. But, you know, companies that understand how to allocate their own capital and how to grow efficiently. And I think when I say we, I mean all of us here, are actually helping them do that by providing some type of financing that is either, you know, dilutive in your way, but, you know, obviously a more permanent source of capital in our way, something that is not impacting the cap table, but, you know, giving them something that they can grow with, and, you know, hopefully through an asset that they are going to yield more than they're paying us. It's a good structure. And, you know, so we have gotten very expertise and knowledgeable on what types of CapEx and equipment do our customers need, how are they using it, and what we're seeing is, you know, a broad-based standardization across markets. So, you know, there's a lot of groups that are providing financing to one operator in one state and a kind of disparate, you know, operator in another state. We are funding multiple facilities for customers because our customers tend to be in multiple states.
Mm-hmm.
So, you know, what we've seen is one piece of technology is being rolled out in Colorado, for example. Once they have determined and confirmed that that piece of technology and equipment is what they want to work with, now they need 8 more. And it's going to, you know, Pennsylvania and Massachusetts and Florida and California and whatever other states, you know, they're looking to build into. And so, you know, listen, very similarly to how real estate needs are going to evolve as the regulatory regime changes, the same is going to be said for CapEx and equipment. And so today, you know, we are seeing, as a state rolls out, it's a newer state, maybe retail's not fully built out, maybe distribution's not fully built out. You know, there might be one level of CapEx and equipment that is required for us to finance.
Mm-hmm.
As that state matures, the market gets bigger, they have more distribution channels to sell product, it might be something bigger or more automated, or, you know, carry a heavier price tag so that they can meet the demand. And then, you know, there's going to be an era in the future where the state by state dynamic of our industry, we can all throw out a guess as to when that may fall, but at some point you're likely to see regional facilities or nationwide facilities. And so we will be providing financing for the next level, the next generation of what it is that the industry matures into. But, you know, I think one thing that we always say about our product and our business, and I think, you know, probably is the same that the other guys on here will echo, is we're addressing an industry today because we think the industry is growing significantly, you know, can generate interesting returns to our shareholders and investors and on our own capital.
Mm-hmm.
But the industry is going to mature and evolve. And at least at XS, we're not building our platform for just today. We intend to evolve and mature with the industry.
Mm-hmm.
And whether that means cost of capital, whether it means the products we offer, whether it means, you know, just thinking about the types of things that we're financing differently. We've already seen an evolution since we started. And I think, you know, we'll continue to see that moving ahead, and it may even impact the types of customers that we're trying to finance. So, you know, we're obviously keeping an open mind about that, but, you know, there's a very big difference between what you read in the news. I'm sure we can all appreciate this, and, you know, immediate exuberance surrounding what's happening around cannabis, and what we see on the ground, which is this industry is moving, and it's moving quickly, but it's not moving at the speed that maybe headlines would lead you to believe.
Right.
And so, you know, we've got time. The industry is still fairly nascent, and, you know, it's going to take a while for this to ever look like alcohol or other CPG style businesses. So I still think we're in the very, very early stages of a 9-inning baseball game.
Totally. You know, David, it's funny. We like to joke internally that the industry is simultaneously moving at the speed of light and at the snail's pace, right? And, you know, we've frankly seen a lot of investors get burned by just being too early, right? And being in a sector where certainly there could be huge upside longer term, but today it's like, okay, how do we literally get product on the shelves, right? So it's, straddling those two kind of different wavelengths can be a little tricky at times, but it's part of the excitement of being in the industry. And David, you also mentioned, targeting interesting returns for your investors, and that, gets, I think, is a great segue into the next conversation of, I'd love to talk about the investments that we're all making, right, in the asset side of our balance sheet, in the sense of, what are the returns that we're thinking about for our investments, and how does that compare to what those returns would look like, say, in a non-cannabis investment, but of the same asset class, right? So as we think about, venture capital in cannabis or traditional private equity, with traditional private equity, upper middle market funds, you're typically buying very mature, stable businesses, probably growing between 5 to 15% per year. They're most likely already profitable. So you're able to put pretty significant leverage on those businesses. And I'd say most traditional private equity funds will, target gross returns in their base case of, call it 2.5 times their money, maybe 20% gross IRR. Within cannabis, I'd say that premium is certainly much higher, right? Because number one, because the industry is so nascent and the regulations change so rapidly that naturally, adds an additional element of risk to the industry, right? And so, we're not like a seed stage or pure venture type firm, in the sense that, a lot of those very early stage funds will look to have a couple of investments that 100 plus X their returns, many that go to zero, and a few that, return costs or maybe do slightly above that. We're really more focused on later stage investments or growth equity type returns. So what we're typically looking for, I'd say, is, returns in the 5 to 10X range for our base to home run case, and that have relatively low likelihood of complete loss of principal. And as we think about, the full fund size, so we're really targeting, gross to net returns of 3 to 4X. And so there's certainly a very significant cannabis premium because, as I mentioned, it's a very nascent industry today. And so we'd love to go around the horn and get everyone else's thoughts on, how their investment returns compare to traditional asset classes. So Kyle, why don't we start with you on the real estate side?
Yeah. It's tough for me to talk after you guys can make the returns that you can make. But the truth is that, look, my fund is a lower cost provider. Again, like I'm really focused sort of on a non-cannabis LTV. And so the way I win those sort of deals is by being, one of the lower or the lowest cost providers that I know of, like in the space, right? So I don't know, when I first got into this industry, it was kind of like 2018, and I could do 15 cap deals all day. Now it's like, I'm putting money out like in the low to mid double digits, right? Like with the stronger operators, like, I've done deals around 11%. As that relates to kind of real estate, I think it's twice that of normal real estate, right? Like you're buying a building in San Francisco. Well, I don't know, San Fran's not a great example because things have changed there. But if you're buying a building in a strong area, right, like it's going to be below a 6 cap almost always. We're making comfortable kind of 12 cap returns here, and those are unlevered. And they throw off yield. So simply put, I'd say our returns are kind of twice that of typical real estate in terms of yield, but that's probably the lowest you're going to hear on this panel, because we're just lower on proceeds.
Mm-hmm. That makes sense. David, how about from your end?
Yeah, so if you use that general mantra, right, you compared it to traditional private equity, and Kyle's comparing to traditional real estate type returns. We view what we're getting as secured returns that look like traditional private equity, but for being a secured lender, right? Against collateral that, while being used by cannabis companies, really isn't specifically produced for cannabis at all, right? So we finance vehicles and testing equipment and packaging equipment, filling equipment, and all these kinds of things. Most of what we're financing, unlike, specifically what Ting's doing with, inventory, or what Kyle's doing with cannabis focused properties, we're really focused on collateral that is being used by cannabis businesses, but isn't necessarily specifically created for cannabis businesses. So in a downside scenario, we have the ability to redeploy that equipment into really any industry, which we think is a nice advantage for the collateral. But in terms of returns themselves, we're targeting high teens, unlevered. We do have some leverage in our portfolio. So, on a leverage basis, we're really looking to be in the high 20s. But to be in the high 20s with security and guarantees from, top 10, top 15 MSOs in the country, we think that our risk-adjusted returns are compelling. And much like everybody on this panel, we're leaning into it as strongly as we can.
Absolutely. That's great. And Ting, how do you think about your returns relative to traditional working capital finance companies?
Sure. I mean, on the factoring side of things, as I mentioned, we charge 2.5 to 3% from that 30, but it's also on a flat basis, and then our advance rates are 75 to 80%. And as we've looked at traditional non-cannabis industries, we've seen general business factoring rates as low as 1% from that 30 and 85% plus advance rates. Certainly, there's definitely a cannabis premium associated with what we're doing, and I think part of that is driven by the cost of capital that we're bearing as well. But certainly there's a greater element of risk when you're dealing with over 1,000 retailers just in the state of California, of whom many of them are not part of large retailer groups, but are rather just small medium businesses and proprietorships who oftentimes are paying the majority of their payments in cash. And so I think the cash-based nature and complexity of running a cannabis business has created a large tax on everyone in the supply chain. Our hope is that over time that will obviously continue to decrease. For us, I think one of the things that de-risks that quite a bit is that we've also created and collected this really a unique data set of retailer transaction and payment behavior over hundreds of millions of dollars of wholesale transactions, which allow us to underwrite retailers where there may be limited credit information from any other sort of information source. And so that, I think, proprietary angle is what is really driving our ability to feel comfortable doing this. And ultimately, I think what I want to come back to is that our primary goal here is to really accelerate the growth of our brands and our core business. And so while I think the net spread and the returns we're generating here, when you consider what 2.5%, 3% means on when you analyze the net 30 number, at the end of the day, we think that number will continue to compress as we get better rates and the industry matures.
That's great. Thanks, Ting. And so just kind of diving further into the asset side of the equation, would love to hear how everyone goes about sourcing great investment opportunities. So Ting, why don't I pass it back to you, and would love to get your thoughts on that front.
Sure. I think with our current platform, what we've created, just given that we're very much tech focused, is this fully built out platform that allows brands, manufacturers to have a one-stop shop to set up deliveries to any retailer in the state of California. And so, for us, because we're ingesting that information already, it's a streamlined platform to then directly feed it into the factoring platform where, any brand that works with us really has the ability to go in and decide that they want to get paid early for any invoice that we've delivered. So right now it's really constrained around the internal network of all the customers that we have, as well as all the retailers that we deliver to and collect information on. But over the next 6 months, 12 months, as we continue to build out the product features and the platform, we certainly want to expand that ecosystem to include third-party brands that we don't currently work with that still delivered into the same retailers, just because we're obviously collecting that data set, and I think we can apply it in a very similar way. So really excited to see the growth of this platform and then the scale of our volume over time. But I think we're still at the very early stages, and certainly earlier stage of maturity compared to either David or Kyle.
Sure, that makes sense. And David, on your side?
Yeah, we've done things, and fortunately in this industry, we're not spending very much money on marketing and lead generation. Obviously, given the capital constraint element of the space, those who have it and are serving the market, by default, it's easier to attract, assuming you're reasonably priced and know what you're doing, should be able to get deals done relatively easily by hanging out your shingle and proving out a little track record. And so, what we've done is really targeted some of the larger customers, which has acted as a brand awareness campaign for our business. because it's helped put us on the map by virtue of who we're financing. And so, those are aspirational companies for a lot of the SSOs or smaller MSOs. And so they look to those. But we do targeted state by state list building using various sources of publicly available data to determine scale and size of who's in those markets. So that could be using PitchBook, that could be using LinkedIn to see number of employees. Right? There are data points out there that we use and combine that all together give us target lists to say, these are criteria that even though you can't tell what somebody's revenue might be, you can gauge that they might have a decent sized business, and then kind of marry that with some direct targeting that we do. And so for us, we're looking for the finance department, the CFO, maybe somebody in corporate development at those businesses who's likely making that type of cost of capital and financing decision, or at least has the both expertise and ability to bring that topic of conversation up internally. So that's how we think about who we need to be speaking with, not just anyone at the business. But and one of the other things I'll say, and I'm sure everybody would agree with this, is it is a small industry. And so the other way that we source deals that is just practical reality is relationships. Kyle said earlier, we've tried working together. I mean, we've had a bunch of different calls to say, we're targeting a similar customer profile.
Sure.
Maybe there's somebody you work with that it's not just a question of passing along a lead. It's more than likely Ting's customers and Kyle's customers need my product, and vice versa. So you're actually adding value by going to them and saying, hey, I know another funding source that's reputable and has a good product, and I think you'd enjoy working with. You should speak to them. And then it creates this dynamic where the finance groups are talking, much like we are on this panel. So, for us, it's relationships. It's also professional services. The bankers, the lawyers, the accountants, everybody's kind of using the same, however many number of firms and people. And so there's a lot of overlap in that regard. And, one thing that I'm sure everybody can appreciate, we spend a lot of time thinking about reputation and putting the customer first. And so by doing that, and not getting into specifics of how, but just by doing that, that tends to permeate a small industry and presents an opportunity for other groups to reference check and get a sense for who you are, because everybody's 2 phone calls away in terms of, the ability to really understand who people are in this space. And everyone has seen, some maturity of the working professionals, whether it's financiers, whether it's the companies themselves, professional services. I mean, everybody's trying to elevate with those people around the industry who are, quality. And so we've spent a lot of time on that to make sure that, people who come to us, A, understand what our product is, and B, that we're not going to waste each other's time, because we want to know we're selling an educated customer. We're not looking to pull the wool, get anything by anybody. The companies we deal with, they know the capital markets, they know them well. And so we need to come to them with a product, with a service, with an execution style that marries with how they do business. And so I think that's how we think about that.
That makes total sense. Kyle, I'd be curious to get your thoughts here as well.
Yeah, I think David said it nicely, but the thing that resonates most with me is the fact that it's a very tight industry, right? And I think the way we've been able to generate more deal flow as well is by doing what we say we're going to do and actually having money, right? Like, I can't tell you how many deals have come back to me kind of like the 10th or 11th hour, because a borrower I was talking to found a local bank that was going to do it at 8%. And, the business development guy was all in. And the next thing you know, it gets to compliance, and I'm getting a phone call when saying, hey, can you close this in 7 days? And I'm like, no, I need 30, and then we push it out and we negotiate. But yeah, like, again, what we've done well is we've actually put out capital, and we've been kind of people of our word. We refer business to and from our counterparties as well. We've done some, as of late, we've actually done some senior junior pieces. I took a senior with some friends and partners and other deals. who took a junior piece because they're looking for more of a yield. And that was kind of a creative way we worked together. But we have a network of probably 7 to 10 broker / investment banker, whatever you want to call these people. And they're really good, right? Like they have relationships with the companies. They do a lot of the work, is the truth of the matter. We spend much more time, sifting through and turning away deals than we do looking for deals, right? Again, I think the truth of the matter, and Ting will realize this soon enough, is that you do what you say you're going to do, and you actually have money for a period of time, and the deals just come, right? Like I think if we had a lull where suddenly we ran out of capital and didn't do deals for several months, I think that would be the biggest risk to what is otherwise a pipeline that seems to keep growing. The capital is not there yet. The institutional capital is not there yet, and so more opportunities keep coming online, and the capital is still not there, and so. Yes, myself and contemporaries, we're starting to raise more capital, but I don't think it puts a dent in what's actually needed. And so, unlike the typical, it's still slightly competitive, but unlike the typical real estate world where you're bidding against 10 other people for a good deal, it's like, it's more like I've seen the same deal come around 5 times, and suddenly now the guy's willing to take 50% less money than he originally wanted, and we have a deal. So more than most industries, it's reputation based, and again, like just having money and closing deals is how you build a reputation. There are guys who have built a reputation for kind of being super aggressive, and it permeates pretty quickly in a small world. You build a reputation for being a client focused guy, or someone who charges a reasonable rate, or someone who actually closes on time and actually has capital. You're going to have a lot of deal flow, for the foreseeable future.
Totally. You'll have a lot of deal flow. And, Kyle, you mentioned several times there the importance of actually having capital. And we'd love to dive a little bit deeper on that as we move into the liability side of the balance sheet. But just to kind of close the loop on the discussion of sourcing, as we think about, sourcing opportunities, and not to beat a dead horse, but I think, again, yes, relationships are everything, right? Your reputation in this industry is everything. And where we've gotten the best deal flow has been from the great experts, such as the 3 of the folks on this panel, referring us to folks who are raising capital. And as we think about venture capital financing, right, we're investing in the equity side of the cap structure, right? So we're lowest in terms of collateral, right? We have the longest time horizon. So making sure that we're backing just the absolute top-notch management teams that we can, believe we have a great partnership for, call it at least 4 to 5 years in most cases, up to 10 years if things take longer to build out than we expected. And so, having a great reputation ourselves and making sure that we're partnering with management teams that have great reputations in the industry is hypercritical. I think, outside of that, from our standpoint, publishing thought content like this podcast right here has been really valuable for us in terms of generating deal flow and really separating ourselves from the pack of the folks that are investing in the industry today to say, hey, look, we want to be strategic. We want to be very knowledgeable partners to the companies that we're investing into. We're not just, a check that, then you never hear from again and provides no actual strategic value in terms of helping you to get more deal flow down the road. And so, with that, would love to now flip over to the liability side of the equation, which I know it's certainly the case for us. I would suspect it's probably the case for everyone on here, that this is really where the difficulties come in terms of finance for cannabis, right? And I always like to talk about the double-edged sword of the capital markets landscape within cannabis, right? Because, once you have the capital to invest and provide loans or, VC investments or whatever it may be, you're able to get into these deals at much more attractive terms and valuations than you would in traditional industries where capital is abundant and you're really just competing on price. But on the flip side, right, your pool of capital is much more restrictive than it would be in traditional industries. And so that's where I'd really like to focus this part of the conversation. And so as I think about from our standpoint, in traditional closed-ended venture capital and private equity funds, your majority of your limited partner base will come from what are called institutional limited partners, right? And so this can be anything from corporate pension plans, public pension plans, endowments, foundations, hedge funds, et cetera, et cetera. In cannabis today, almost none of those folks will put money behind a cannabis fund. And that's due to a host of reasons, right? Because of the perceived risk, because it's still federally illegal, because of the fact that federally insured banks are just touchy about, cannabis at all. A lot of groups have what are called vice clause restrictions, which say they can't put any money behind any what are called quote unquote sin-related industries. So tobacco, alcohol, gambling, all being included in that sector. And so as we think about our potential investors, we're really today limited predominantly to family offices and high net worth individuals. So where you would typically see, I'd say in a closed-end fund structure where your capital comes from a very consolidated base of very large very large institutions. In cannabis, that dynamic is very different, where there's typically a much longer tail of high net worth individuals and family offices that are putting capital behind the fund. And as we think about, their cost of capital, right? Again, in traditional private equity, the benchmark is historically something like the S&P 500 returns plus 500. Those are really the benchmark that you're measured against. And that plus 500 aspect is typically predominantly driven by what we call an illiquidity premium, in the sense that when you commit capital to a closed-end fund, your capital is locked up for that fund's life, versus if you're just investing in a public equity, you can buy and sell that whenever you so choose. Now, obviously, again, in cannabis, I'd say that premium has probably another 500 bips of additional premium, just because of what we touched on earlier in terms of the nascency of the industry, the fast changing pace of regulations, and that kind of thing. So that's kind of how we think about the liability side of the equation. So David, would love to get your thoughts on the financing side as well for you guys.
Yeah, timing's good. We announced this morning that we increased our bank line. So that's probably where I would start, but the caveat to that is it's a state chartered bank. They have, borrower limits that we're going to hit. So even though they love the business, they're in the business, right? Most banks are in equipment finance or real estate lending or working capital type lending. And so what's interesting about what we do, a little bit different than obviously what you're doing on the venture capital equity side, is our businesses are historically financed by banks, and B, they're typically in our business. So, they lend against property, a lot of them have equipment financing divisions, and they'll even securitize or syndicate deals from other, equipment financiers. So, to look kind of top to bottom for us, we have a senior line from an FDIC member bank, but state chartered. And so that'll only take us so far. We are in the process of wrapping up something on the private credit side to have a large line that we can draw on to fund deals as we need. And, similar to how we view the space as being an enhanced yield there, anybody who's lending to us is likely thinking about it the same way. So they're getting a premium for financing us, and we're getting a premium for financing cannabis. And so, that is why that would be attractive for them. And obviously there has to be enough spread in there for us to make enough net interest margin for it to be interesting. And so, we that is typically how we've done it. And then of course with equity, if you look at somebody like Innovative Industrial Properties, on the real estate side, they have successfully built a sizable portfolio, largely raising equity, or at least up until recently, and back levering. And so I think, for us as a public company, we're sensitive to equity financing. And some of that can be determined, dependent on where we're trading and how our stock is performing to make that decision. And ultimately, whether or not borrowing, raising equity are the right decision is really just based on how we view the cost of capital at that time. But, I think one thing that we probably are all doing is there's always this balancing act of committing to deploy capital, raising capital, and finding that sweet spot, between what you're paying for your capital, what you're deploying capital for, and always making sure that you are able to fund your commitments. And that is generally the kind of the hot step that we're all doing to a certain extent. And so, and frankly, even on the VC side, I'm sure, because you guys are looking at a lot of deals that, I'm sure you'd like to fund. And I think it goes the same, whether it's debt, equity, or otherwise. So that's how we think about it. It's a combination of all of the above.
Great. Thanks, David. And Ting, how about you and the Nabis team? How do you think about the liability side of the equation?
Sure. So, Jordan, as you know, Nabis as a whole is a venture-backed company. And so we have this complexity around, on one hand, building a distribution platform, but also on the other hand, wanting to invest significantly into the technology components of what we think is a really important part of the DNA of the company, is really building on that tech IP, the ancillary services that we really want to drive value throughout the ecosystem. And so, as we've explored financing options, Nabis Capital has become a bigger part of the discussion around how we should finance the overall company, which continues to be, equity driven. We just announced our Series B a few weeks ago, the initial close of 23 million. We're hoping to close over 30 once all is said and done. But then on Nabis Capital side, we've been in discussions with various forms of creditors, either through venture debt or with discussions with our local bank, which is also state chartered, around what might make most sense to prop up the balance sheet as we continue to scale out the lending side of things. And we're just going through the legwork that needed to make sure the structuring was correct, because obviously our equity investors are also sensitive to any movement on the credit side that may impair their value. So I think if we were purely a credit investing company or purely a distribution company, I think it'd be an easier conversation. But we're just trying to keep our cost of capital in mind, along with the governance and risk structures there.
Yep, that makes total sense. Thanks, Ting. And Kyle, as you were mentioning in your last response, actually having that capital is so hypercritical. So would love to throw it over to you and get your thoughts on the fundraising side of things.
Well, we we more so than some, we kind of really had a principles sort of, again, it was a lot of the kind of family money, and so it really was a principles investors mindset. And so to this point, my fund has been totally equity. We actually have no leverage yet. We're seeking leverage, talking to sort of mid and smaller banks, a lot of private individuals, some state banks. And David mentioned this, and it's obvious, but the rate obviously is the key, and the truth is the cost of capital, from our perspective, is still a bit high. When we think about, when I think about the longevity of the business, I don't think it'll be a 15 or a 12 cap rate environment ever, but I also don't think I'll be getting zero leverage. I think it's much more likely that, if SAFE or some version of that comes in, the banks will slowly limp towards lending to guys like us long before they get into lending direct to the businesses, right? So even if it's an 8 or a 9% cap rate environment at some point down the line, if we're getting money at 4 or 5%, then we're going to be making a 400 basis point, 500 basis point spread, and things will be great. Hopefully we have a company that's 5-10 times the size of the current company, and that's plenty of money for everyone to make. But we are definitely entertaining leverage. Again, now that the first fund's equity is spent, we kind of made a decision that we want to get some leverage. We're talking low LTV stuff, right? Like, we want to keep our rates kind of that we can get leverage at in the 7-ish% range, which is not so easy to do in cannabis. But we have a few guys, and what we may do kind of as an alternative in the short term is just lever on a property by property basis. Specifically, some of the smaller banks who I'm talking to will only do it on an asset by asset basis. They won't lever the portfolio. So, as we sort of cobble deals together as we go, right, that's kind of a simple way to do it. And again, I'd love to have a line, and I'm seeking something like that. But for the time being, at the rates we're getting, we're just doing it asset by asset. But even before that, to this point, we kept it all equity. It's friends and family, and then we were on a crowdfunding platform called CrowdStreet. We raised about $10 million there, all from small retail investors. We probably have 300 investors in our $50 million fund, maybe 250, but you get the point.
Sure. That's great. Thanks, everybody. So, I'd love to talk a little bit about, how we can support each other across the cap structure of the companies that we're working with, right? Because, in one sense, you could argue that each of us on this panel is competing against each other as, we're driving down our clients' cost of capital. But I think, as has probably become pretty apparent on this conversation, in a much more realistic sense, we're very much complementary to one another because capital is so scarce within the industry, and our clients just are desperate for any type of financing solution that can free up that cash for whatever it may be that they really need to continue to drive in growth. And so would love to throw it out to the field and say, if anyone has thoughts on, what each of us on this panel can really do to help support one another. So anyone wanted to jump in there?
I mean, look, I'm happy to go first just to say that, look, what the most obvious thing is, an exchange of deal flow, right? Like what you get, or you get companies that say, hey, we need money, right? Like they say we need $5 million and here's what we have. And, like whether it makes sense as an equity or an equipment or real estate, inventory or some combination thereof, right? The first thing we can do simply is just be referring one another deals, which, I certainly plan to do so going forward.
Sure.
But, the second thing that I've done of late, and I think is really helpful, is like, look, again, at least from my perspective, the problem is that I've got a product that seems great to the cannabis company, but I can only solve for 60-50% of the capital they need, within kind of the confines of my charter. Not to say that there's not equipment involved or potentially inventory, certainly equity, right? And so what I try to do, what I've done just recently, and what I'm trying to do more of, is really kind of cobble deals together, right? So if I was working with a company and I had 70% of the money, and the rest might have to be equipment or junior in some fashion, but yielding a higher return, I could invite you guys into that and say, hey, this is basically a B2B transaction. We have it, 90% of the way there, and all we really need is, the extra 30% of this deal to get it done. That's where I think the industry is going to go eventually, because again, like it's not just equipment, it's not just real estate, it's not just inventory. It's all these things that the operator is trying to solve for. And so I think the best way is to sort of cobble money together, offer a certain rate that's kind of in between what all of us are charging, right? And it looks better from the company's perspective. And then, I take 300 basis points less. You guys take that, on the top. That's what I did in my last deal. And I think that's a really great way. I mean, maybe that's just because I'm in a very specific charter and I need to be senior and et cetera, et cetera. But I really believe that the operators have kind of large capital needs that one particular group might not be able to solve for. And rather than pass people back and forth, if we can, team up and actually fund deals together, I think that's where the industry is going.
Absolutely.
I'm gonna piggyback on that and say I have been talking about, and Kyle and our firm actually have a mutual banker who is near and dear to our business, and I know his as well. He's been a terrific source of deal flow, and I'll plug him just because I know he'd appreciate it. Gopal Garuda. But
now you made me look bad.
Say again?
Now you made me look bad for not.
You just need to reinforce that it's legitimate. No, he's one of the hardest working and best guys that we've gotten to know, and he's been responsible for some of Kyle's deal flow and certainly some of ours, and making the connection between our firms. So, a lot of history there to speak about. But, we've been talking for a long time, and it's not necessarily on the radar this minute, but I'm going to kind of double down on what Kyle said, which is I think what the industry is sorely missing is a firm that can be more than a one-trick pony, especially on the credit side. And I think that is something that we as a public company at XS, while we're not necessarily thinking about this minute, it is in the back of our minds at all times, which is, if you're bringing together three firms to kind of, crazy glue and stitch together a capital, solution for somebody that addresses their need, scale matters. The ability to service that need at one place could be a real differentiator that wins deals. And I think over time, as much as you're going to see consolidation of the plant touching operators and service firms and what have you, we just saw a law firm get acquired, right? I think you're going to see the same thing happen on the capital funding side. And some people are going to pair better than others or not, but we have looked with Rainbow, Kyle's firm, at, coming up with a solution similar to he laid out, where they're only going to go so far in the capital stack of what's needed for a full build out of a facility, which would include CapEx and equipment. And so for us to be able to come together, go to the customer and say, hey, we've just taken out the question mark of, can you find this other piece? We're going to solve it together. But that's two different firms running two different credit processes, surrounding two different timing. So there's challenges. It's not just a natural layup. If you can do all that under one house where everybody is focused on the same goal, that becomes a really interesting solution. So, over time, we'll see how things play out. But, we are, as much as we're also making friends, trying to share referrals and put people on a pedestal to win business and this and that, we're also trying to build relationships, because I think there's going to be M&A surrounding the financiers in this space as well. And this industry is lacking where a firm like where you used to work, Jordan, which would be something like a GE Capital, that can handle, multiple tranches of the capital structure. So I think over time you're going to see that, but it's hard to see today. But one thing that I'll touch on in addition to that is, we talked about cost of capital and a lot of the challenges that all of us have. And there was no clear answer of, oh, we're just going here for 4% money. That's not an answer you heard from anybody. But when you look at, the large scale debt financing that, again, using IIPR as a good example, just accomplished, they were able to achieve, a mid-single rate number, but they had scale. They already had the portfolio. They have the asset base. So as we all get bigger, whether individually or together, that scale is going to help achieve, and performance, of course, is going to help achieve a lower cost of capital, hopefully faster than the industry cost of capital drops. So that is something that I think we're going to be thinking a lot about here moving forward.
Absolutely. Yep. Great. Ting, anything to add on that front?
Sure. I think Cannabis has a unique position of potentially being a future customer of David and Kyle's as we continue to scale our distribution business, but also having, the networking point, a large portfolio of customers that on one hand, continues to grow, and on the other hand, continues to grow bigger as a customer list of, larger and smaller brands that we continue to aggregate onto our platform. And so, I think, and they, whether it's an introduction from our brand portfolio or an introduction of one of, from David and Kyle, one of their clients, I think Cannabis presents, just even from the distribution standpoint, a unique opportunity to help make their investment a success, in terms of not just getting the building up and running, not just getting the equipment in place, but also getting the product to the market, into the hands of consumers, who are going to be buying them at the end of the day. And, I think for us, as we continue to grow the volume that just channels through our platform, I think there's a way to make, our ability to monetize that through the factoring side of things, just, more compelling and scale, even faster, I think, through the benefit of, these kinds of introductions and just customer relationships.
Yep, absolutely. Absolutely. Great. And so now let's ask everybody to take out their crystal balls and think about what the future looks like for each of your individual asset classes, right? I mean, how does everybody think that, their specific sector of specialty finances is really going to develop over the near to medium term, right? What is the competitive landscape going to look like over the, call it, next 2 to 3 years? And, we obviously saw some major legislation proposed by Schumer yesterday. And, regardless of whether or not that specific legislation has any real chance of passing, I think it is a strong indication, at least, of the direction that legislators are pushing for the industry to move. So, with that, would love to get everybody's insights on, how legislation could impact their sector and how they view the competitive landscape developing. So, again, throw it out to anyone who wants to jump in there first.
I'll kick it off.
Great.
We're in a unique position at XS. There are very few, if any, companies doing what we do at scale. There's some opportunistic groups, equipment, understanding values of equipment, types of equipment, that is somewhat nuanced. And we've built out now, I think 200 or so different preferred vendor relationships with different original equipment manufacturers, distributors, et cetera. And so, we have done, I think, a pretty good job of getting to know that side of the business. And, there's some nuances involved surrounding tax structuring and things that we do to structure leases on a state by state basis to help companies qualify for sales tax exemptions and different things. And so there's some nuance to it. Not that there isn't with any business, but in ours, I don't think people naturally gravitate towards CapEx and equipment finance. And so, what we're excited about is we don't see any competition. We've seen some small ticket, either opportunistic capital or here and there try and finance, securing smaller investments with some equipment, what have you. But at scale, we haven't. And that was one of the reasons we moved in this direction is my background was real estate development and investment. But real estate we thought was a little bit more competitive. Still, even today, as has been pointed out, there's not enough capital to address the need. So it's not that competitive. But we don't really compete with anybody directly for our product. And we think that that's, a huge advantage for us as a first mover to really move as quickly as we can to build that moat and stay in that position.
Yep. Great.
I can jump in. There's sort of two sides to it, right? Like first off, just I guess to more broadly, where we think legislation is going. My personal view is that the latest legislation doesn't really do a whole hell of a lot. I personally think I think it's a positive piece of paper, but I think it's more for Schumer's own reasons than it is for moving cannabis forward. Midterm elections come up next year. I just don't see a lot changing before then. And then my other just more broadly, I don't necessarily think cannabis will be legalized or anything near that during the Biden term. And so when it happens, I think it's going to eventually happen for sure. But the reason the stocks are kind of down today is because like people were expecting the legislation to be like a great step forward, and it's just like a tiny tiptoe at that. And that's what's been happening in the industry a lot, right? Like Georgia went blue and the stocks went crazy, and then a month later everything kind of fallen off and has fallen off ever since. And it's because people got a little overexcited a little early. And the truth is that the industry is kind of moving slowly. We certainly have competitors, right? Like I think the bottom line is that there are way more needs for capital than there are capital available. But IIPR was mentioned. There's certainly the gorilla in the room. The way we kind of compete with guys like that again is we try to keep our costs a bit lower. And where I see my personal business going, and I guess like most of the cannabis real estate industry going at large is, look, I mentioned this before, but I'll just restate that I think guys like us are going to be the first who are able to get bank financing or close there too, right? If cannabis gets federally legalized tomorrow, JP Morgan's not going to be lending direct to Curaleaf. I don't think so. Not right away for sure, right? I think it's going to take time. Banks will limp in, and so again, even if it goes from, in my world, a 13 cap rate environment to an 11 to a 9 really quickly, if that means I'm getting debt from 7.5 down to 6.5 down to 5.5, there's plenty of business to be done. And David's right. A really big key to what we're doing is trying to scale, because we want to be larger. We want to be able to get our rates down. We want to be able to do more business, even if it's at a slightly lower yield. And that's a lot of what we're focused on. That's why more of my pipeline and more of what I'm doing today is on the lending side versus the sale leaseback side, because the sale leaseback side is more competitive. The operators themselves prefer to own the properties, and so I think there's a nice niche to put out a lot of money over the next several years, kind of in the cannabis lending sphere, securitized lending sphere. And from there, again, it's a game of, it's just a spread game, right? If I can get my cost of capital down at or near the same rate that the cost, that the operator's cost of capital goes down, then we're still in business. And that broadly, that's what I think is going to happen.
Yep. Yep.
I think I would echo what David and Kyle said around just the need in the industry for capital. There's certainly larger factoring focused businesses in space, and from our standpoint, we're obviously well aware, but just I think there's an opportunity for everyone to grow as the market continues to grow, just given that the market opportunity is so large and underserved. From a cost of capital standpoint, we certainly think that over time rates will go down. That because we're aggregating so much more volume than our customers, that will benefit from that scale. But to Kyle's point, the timing is certainly unknown and unlikely to have any near-term movement in a way that is drastic. So I think as we look at Nabis, at the end of the day, I think as I mentioned before on this call, we view the product as something that is really more value additive to our customers at the end of the day. And while the factoring rates are something that we are doing a lot of homework around to make sure that we're not losing money, we think it's less of the core value or revenue generated product that we're offering, and more so just a value added service. So we want to make sure that in the day that everyone's growing. So I think our view is that we're going to be offering rates that are probably competitive, if not less than what everyone else who's focusing on it is doing. So there's definitely a niche for being a one-stop shop, and we think that that's going to be a great value driver for our capital business.
Absolutely. Absolutely. And on the regulatory front, I would certainly echo what Kyle was saying about, thinking it being pretty unrealistic that anything happens under President Biden's administration. And, in fact, I recently read President Obama's book, and, it was really interesting and in a lot of ways, unfortunate insights into, how the sausage is actually made at the federal level. And, you kind of recognize that as a new presidential administration comes in, they tend to have a little bit of a, called 100-day grace period where things can actually get done. And I think that was why after the blue wave in January, people were so excited about cannabis and thought that there's going to be this major change. But, now that time frame has really passed us, now you get back to traditional partisan gridlock where, despite the fact that the vast majority of Americans all are in favor of, cannabis legalization, now you see our politicians are more focused on, making sure that their party wins more seats at the next election and not actually getting legislation passed. And I think, if you haven't seen anything passed by the midterm or, 6 months even before the midterms of next year, then, nothing's going to happen during the Biden administration, unfortunately. That's at the federal level. Now, let's not forget all the incredible progress that's being made at the state level, right? And so, I don't want to sound all doom and gloom from a regulatory perspective, right? I mean, already this year, we've seen New York, New Mexico, Virginia, Connecticut legalized. So there's still so much embedded growth that even if federal change doesn't happen as quickly as it should, or we'd all hope, there's still huge progress that is being made. And then, as we think about venture capital financing going forward, certainly there's going to continue to be more and more competition on that front, more funds coming into space. I think in a lot of ways, COVID actually prevented some new entrants from getting into the space just because no one was launching new funds during that time period. Again, there certainly is going to be more competition, although, as I touched on earlier, given the fact that a lot of institutional funds have these vice clause restrictions, that, there's still always going to be a large number of private equity and venture capital folks from outside the industry who are never able to get in. Now, we would certainly argue that the whole classification of cannabis as a vice is nonsense, that there's clearly more medicinal purposes for it than there are, drug, quote unquote, related aspects, and that by classifying it as a vice, you're continuing to perpetuate all the historical injustices that have been, committed as part of the war on drugs. But anyway, that's a conversation for another time. So anyway, just to wrap things up, really appreciate everyone for taking the time to be on this panel today. I would love to just quickly go around the horn and if you all have email addresses or ways that potential customers or investors could reach out to you, here's a chance to go ahead and plug those.
Yeah, David Kivitz at XS Financial. It's DKIVITZ at xsfinancial.com, or anybody can try me on cell 202-309-1166. And I would just add to it, I think everybody would probably agree that legalization is a very double-edged sword for all of our businesses. And so I think there's this idea that, the public wants it. Clearly that's what the numbers indicate, but it comes with pros and cons for all of us. And the same can be said for any of the companies we're financing. So it's going to be interesting to see, not so much will it legalize, it's coming, right? At some point in time, as everybody's alluded to, it's really the how. How does that roll out? That's really going to be what matters most for all of us.
Great.
I'll go. Yeah, look, I agree with what a lot of David said. It's definitely a double-edged sword. Frankly, just I know for sure that status quo is a good situation. So the fact that the legislation wasn't as enthusiastic as everyone hoped, from my perspective, is just fine. And I agreed. Like it's an inevitability. So when it happens, it's sort of unpredictable. But at least from my perspective, again, the bigger the company can be before that time, I think the better. So status quo is okay for me. But my name's Kyle Schenfeld. I'm the president of Rainbow Realty Group. My email is Kyle, Kyle, at rainbowrg.com. My number is 516-996-9261. I almost always pick up. I'm up very early. So call me anytime as well. And again, thanks for everyone's time. Thanks, Jordan, for hosting. I enjoyed it.
Yeah, thanks, Kyle. I think to your point, the point around making sure that we achieve the scale, that as much scale as we can, I think is really echoed, and as we view, our strategic future of really racing to be too big to fail effectively, in these industries. We want to be a critical component of infrastructure, and on the capital side, I think the aggregation is going to be key to be able to continue outpacing that decline in rates for customers. As it relates for customers to reach out, I think the best email would be capital, CAPITAL, at nabis.com. We're building out a full team and really excited for the growth of the standalone product. But happy to reach out to any interested parties and onboard onto the platform, or let them know future product developments.
Fantastic. Well, thanks again, everyone. This was such a fun panel. Really appreciate your all's time, and look forward to finding great companies to support the capital structures with y'all. So thanks again, and have a great afternoon, everybody.
Thank you.
Thanks again, guys.
Thanks all.